Welcome to the latest update on the Australian housing market from RP Data. Today, we will be taking you through the latest RP Data-Riskmark Hedonic Home Value Index results, which are for the period up until January 2011. January was an extremely quiet month for the Australian housing market. This was partly due to the normal seasonality in the market, where both buyer and seller activity tends to dry up over the first half of the month. This year, however, the January slowdown was compounded by the widespread effects of flooding and severe weather that disrupted the market during the month. The low number of home transactions is likely to have resulted in a greater amount of volatility in the preliminary January figures. Our January index data will be revised at the end of next month, so it will be interesting to see if the final results are as weak as what the preliminary results are suggesting for January. Home values across the combined capital cities fell by 1.6% over the 3 months to January 2011. This is the largest month-on-month fall that we have on record. The previous largest downwards movement in the Australian Home Value Index was back in mid-2008, in the midst of the GFC, when home values fell by 0.7% in June. As you can see from this graph, which tracks the rolling quarterly change in home values across the combined capital cities, value growth began to evaporate during the June 2010 quarter. It also highlights that since that time, the Australian capital city housing market has been virtually flat in terms of value movements. This slowdown in value gains can largely be attributed to higher interest rates, coupled with a stronger growth cycle since January 2009, both of which have created affordability barriers in the marketplace. While capital gains have slowed, the market has largely been resilient to value falls up until January thanks to strong employment and economic conditions. Regional markets have recorded a lower rate of capital gain than the cities over the last 12 months. Home values in the regions outside the capital cities fell by 1.3% over the 3 months to January 2011, and they're down by 0.2% over the 12 months to January. Performance for the housing market within the regional locations is mostly being dragged down by subdued conditions along the coastline, where the tourism sector continues to experience weakness, and the once strong sea change migration has pretty much stopped entirely as prospective retirees seek to re-establish their nest eggs post-GFC. Leading indicators, such as the average selling time and the average level of vendor discounting, now appear to be levelling, suggesting that vendors are becoming more in tune with the lower price expectations from buyers. The average number of days for a home to sell is now about 46 days compared with 42 last year, and the average level of vendor discounting, which is a measure of the difference between the original listing price and the ultimate selling price, is now 5.9% compared with 4.8% in January last year. Despite the levelling in these indicators, listing volumes are at a heightened level, and although clearance rates are improving, they're also at below average levels. Rates of capital gains have been vastly different from market to market and region to region. Perth and Brisbane continue to underperform compared with the other capital cities, while most other capitals are now recording a slowing rate of capital growth. Perth, Brisbane and Canberra have all recorded a fall in home values over the most recent 12-month period to the end of January. Darwin is once again the top performer, recording a growth rate of 4.7% over the year. Over the year to January 2011, Sydney recorded capital gains of 2.5%, which made it one of the best performing capital cities of the year. Conditions remain comparatively healthy compared with other cities, with homes selling in just 39 days on average and vendors having to discount less than the national average. The rate of capital growth in Sydney has slowed in recent months, however. We still expect it to be one of the better performers during 2011, thanks to a continuing undersupply of homes and strong population growth. Until December, Melbourne had been the top performing capital city over the last 2 years, with capital gains of almost 24% over this period. Add to this a gain of 21% in Melbourne home values during 2007, and it can be seen that Melbourne has had a very strong run of capital gains. Conditions are slowing quite quickly now, with days on market and vendor discounting trending higher. Auction clearance rates have been improving, but remain quite below average. Rental yields in Melbourne remain the lowest of any capital city due to strong growth in capital values and a relatively flat rental market. Brisbane has recorded the second weakest rate of capital gains over the last 12 months, with a fall of 3.7% in home values. Only Perth has recorded a weaker market performance over the past year. Homes are averaging about 2 months to sell now, and vendors are having to provide large discounts in their asking prices in order to sell a property, indicating that asking prices are still not quite aligned with market expectations. The silver lining for Brisbane is the fact that rental yields have been improving due to the lower home values and modest improvements in rental rates. Adelaide has recorded falls over the last quarter, with values down by 1.3%. Over the year, Adelaide home values recorded a gain of 2.0%. With a median house price of just $410,000, Adelaide remains the most affordable mainland capital city for housing. Average selling times and discount levels continue to trend upwards in line with the combined capital city average, and rental yields in Adelaide are slightly below the Australian average due to the strong capital gains recorded previously. Perth remains the weakest capital city housing market in Australia, recording a decline of 2.6% in home values over the 3 months to January 2011 and a 3.8% fall in home values over the year. The Perth housing market has remained in the doldrums since about mid-2007, with the market still recovering from the excessive capital gains recorded between 2005 and 2006. Selling times and discounting levels are still above average, and rental yields are also yet to recover despite the fall in home values. There may soon be a light at the end of the tunnel for the Perth housing market. The surging resources sector, strong population growth and employment growth, and improved affordability situation are likely to see Perth eventually start to show an improved housing market performance. After recording greater than 10% growth each year over the past 5 years, capital gains in the Darwin housing market have slowed to just 4.7% over the year. It is likely that affordability constraints are putting the brakes on capital gains in the Darwin market, despite the fact that rental yields remain the highest of any capital city in Australia. Average selling times and vendor discounting are also trending upwards, suggesting that the Darwin growth run may be taking a breather. On the flip side of this argument, though, unemployment is still extremely low in the Northern Territory, and the employment participation rate is one of the highest in the country. This highlights that the Northern Territory economy remains very healthy. Canberra home values have recorded a fall of 3.8% over the 3 months to January 2011. On an annual basis, home values in Canberra have now recorded a fall of 0.6%. Selling conditions remain better than the national average, despite the current soft market conditions. Homes are selling in about 47 days, and on average, vendors are discounting by around about 4%. The rental market in Canberra is one of the best in Australia, with rental yields well above the national average, largely due to the low employment rate, relatively high wages, and a largely transient working population. In summary, the January 2011 results have been fairly weak. However, it is likely they have been affected by a very slow month of sales activity, further hampered by natural disasters. Given this, we may see a significant revision to the results next month. Looking forward, our outlook for 2011 remains fairly subdued. The performance of the housing market will be largely dependent on interest rate movements. The current variable rate is at about 7.8%, and although the interest rate futures market isn't anticipating any interest rate hikes until February next year, we expect that they will occur earlier than this. With the mining sector performing strongly, a tight employment market with historically high participation rates, and wages increasing at a rate above inflation, we expect that rates will have to move higher at some time this year. If interest rates do move higher, we believe the Australian housing market will remain fairly flat, with a potential for only small nominal rises in home values. The counterbalance, of course, to higher interest rates will be a very tight jobs market with employment already at capacity. We are likely to see improvements in household incomes, which will in turn improve the affordability scenario in Australia should capital gains remain fairly subdued as anticipated. If you would like further information about the Australian housing market, visit www.rpdata.com.